What's up, everybody? It is Wednesday, April 6th. There's a lot going on. And this is a really cool period because there's a lot you can learn here. I mean, just follow along, and I'm trying to help you. And there's a lot you can learn from what is going on right now. All right, so today markets were down. Dow was down, I think, like about 0.5%. Nasdaq was down over 2%, like 2.25%. S&P was down, but it held its support levels I sent out earlier today to my subscribers. The big thing today, well, it was, it started off with ongoing fears about aggressive Fed rate hikes and stuff like that, and I talked about that yesterday with Lyle Brainerd, vice chair, saying, hey, we got to go real aggressive. But it's a fascinating period, folks. There's a lot to learn here. If you're interested in just being a spectator and learning from this, I mean, it's even myself, I mean, it's great. So today, what added to the panic selling, and that's what it is really, and I'm going to explain it, but we got the Fed minutes, and they're talking about now rolling off $95 billion a month from their balance sheet. And I think originally it was thought like they're going to do maybe 70 or 80 billion, maybe 90 at the upper end. Now it looks like they're going to do, I think it was 60 billion in treasuries and 35 billion in MBS, if I'm not mistaken. But anyway, the amount was 95 billion. And everybody freaked out because you know what the belief is here, that it's a tightening, quantitative tightening. You know, what's interesting to me is that, you know, a lot of people are just fixated with like, where it's double entry accounting. So in other words, you know, it's like physics. For every action, there's an equal and opposite reaction. For every debit, there's a credit. For every liability, there's an asset. For every debtor, there's a creditor, right? So I mean, when they're rolling off, you know, something from their balance sheet, and that results in a reduction in reserve assets. Okay, at the same time, something else is happening which offsets that. Yeah, reserve assets at the banks are going down, but securities and other assets are going up. I mean, securities are, rather than the Fed taking those securities onto its books, and by securities I'm talking about Treasury, securities agency, securities, MBS. Rather than the Fed taking that on its books and earning that interest, those things stay in the economy and the economy earns that interest, okay? And like I said yesterday, to the reduction in reserve assets, to the extent that happens from this roll-off, you know, and it will, but we also have to account for the fact that government spending will continue to add reserves in the system. But let's just go with that 95 billion a month. To the extent that reduces reserve assets, that creates space on bank balance sheets for other assets, okay? I mean, and banks are required to hold a certain amount of assets, and so that's going to be treasuries and agency securities and MBS and loans. All right, so there's an offsetting thing going on here, which I don't think is negative. I mean, if banks are able to make more loans, if banks are going to hold more interest earning assets like treasury securities and MBS, I mean, that's going to go to their bottom line. It's going to help their capital, and that feeds into their ability to lend more. All right, so nobody looks at this. They're just looking at that. They're looking at that decline in reserve assets, and reserve assets, they just sit there on bank balance sheets. It's not like the banks take those and buy stocks with it. I mean, it's not. I mean, it just sits there on bank balance sheets. So, you know, taking them off, I don't see that as a bad thing. I just do not see that as a bad thing. But this is how it is perceived. It is perceived as, you know, a tightening. Everybody calls it a QT, a quantitative tightening. they look at it as, draining cash from the system. I mean, it's just absolutely, that's not what it is. That is not what it is. So this is one of the reasons I think it's a very interesting and fascinating time, because if you have an understanding of this, if you're following what I'm saying, we're gonna watch this as observers or maybe as investors, and we're gonna learn a lot from this. We're gonna see in actuality what the outcome is going to be, and if it conforms to like the real understanding of what's happening, it's not going to be a negative thing. All right, so that's one part of it. The other part of it is, all right, so let's say they're rolling off 95 billion a month, right? Right now, there's like 6 trillion in reserves. You got 4 trillion in reserves in Federal Reserve banks. You got 2 trillion in the reverse repo facility. So they got 6 trillion that they have to pay money on. All right? And so let's say they're rolling off 95 billion a month in a year. In 10 months, that's 950 billion. So in a year, it's a little bit over $1 trillion, right? It's like 1.1 trillion. Let's say they do this for a year, 95 billion. They shrink reserves by 1.1 trillion. And again, that doesn't account for reserves that are going to be increased as a result of government spending, right? The government runs a deficit. So that's going to be, the deficit means a net addition of reserves into the banking system. But let's just say they reduce reserves by 1.1 trillion. All right. So what does this mean? So now let's just round it off. Now they have 5 trillion in reserves that they have to, there's still 5 trillion in reserves in the system. Okay. I mean, come on. We had nowhere near that before all this stuff started with the pandemic and everything else like that. And the market was fine and the economy was fine. But here's the other point. On that 5 trillion, they're still going to have to pay interest on reserves. And, I've been over this calculation. So let's say they go up to 2.5%. 2.5% on 5 trillion is 125 billion. Last year, the Fed made 111 billion, 112 billion, right? They handed over 108 billion to the Treasury. At 2.5%, they wipe out their profit. So again, I don't know if the Fed is gonna, run with negative cash flow, negative equity. I'm sure that would raise a red flag with Congress. Like, I've been saying this for a long time now, but I just find the whole thing to be fascinating. Like, I can't wait for all this shit to go down. Like, I want to see what's going to happen. Like, it's probably true that the Fed could just keep on crediting, the system with reserves just because it has the ability to do that. But I mean, what's it going to look like if they have negative equity, if they have negative cash flow? I mean, what is it going to look like? I mean, it's really, really interesting. And like, what is Congress going to say when they don't have anything to turn over at the end of the year? Or how are they going to pay for their own operation? I guess they can do that too, just by crediting, whatever bank accounts they need to credit, and that's part of their negative cash flow. But I mean, I find the whole thing to be really, really interesting. I do not find it to be super, like, people are freaking out, super bearish about this, and they're panicking, and it's like, I mean, we're talking about very educated people on Wall Street who have been in their positions of finance and economics and market analysis for a long time. I've been on Wall Street for many, many years, over 40 years. I worked at Merrill Lynch. I was a former member and trader on 4 different exchanges. I worked for a large international bank, Credit Suisse. I mean, I've been around all these people for a long time, and it just fascinates me that, I see them like in hysterics right now. They're really in hysterics, and they're talking about, I mean, one guy was saying, like, the Fed is going to cause you to lose money. That is their program right now. They want you to lose money. And like, okay, I kind of see where he's coming from, but at the same time, when the Fed raises interest rates, that increases personal interest income. That's interest income that flows to personal income. I mean, how is that a loss in money? For every debtor, there's a creditor. And the creditors now are going to be earning more money. I mean, this is just like completely left out of the discussion. Like totally ignored. Like there's the people, very educated, like I said, people supposedly very informed. I don't know if they understand basic accounting. I don't know if they understand that, we live in double entry accounting. Like I said, for every debit, there's a credit. For every debtor, there's a creditor. For every liability, there's an asset. I mean, it's just the other side of the balance sheet is just completely ignored. So it's a fun time. Don't get scared. Don't get nervous. I'm here to hold your hand. I'm here to make you feel comfortable. Don't worry. There's a whole half of this entire reality which is being left out and not discussed. And it should be discussed. But it's just like, that's not what they want to talk about. That's not what they understand. That's not what the focus is. So again, I'm really excited about this whole thing. I can't wait for it to go down. And I think a lot of this selling right now is kind of preemptive of the eventual initiation of this policy. The other thing is, like, why did the Fed wait 2 months? I mean, if inflation is such a big problem and they deem it as such a risk and such a terrible thing, I mean, they had a meeting in March, okay? They raised rates by a measly 25 basis points. Now they're sitting all the way until, May 8th or something like that. I mean, why are they waiting 2 months? We've seen them in past emergencies do like emergency rate cuts or whatever. If it's so terrible, if it's so horrible, if this is such a big risk to the economy and everything, why, they have no meeting in April. So do an emergency rate hike if it's so, if everything is so horrible. I mean, some of the shit coming out of the Fed is just really unbelievable. And people are just, they're just so gripped by this, man. No understanding. They're just running around blind, just so gripped by this. So it's a cool time, folks. Let's enjoy it, and let's sit back and let's watch what happens, and let's make some money. See you tomorrow. Bye.